You're saving, investing, doing everything right, so why does it still feel like you're not getting ahead? There's a hidden reason most portfolios never actually build wealth, even when markets are going up.
All right, so if you're an Indian professional, you're probably doing all the right things, right? Working hard, saving your money, maybe putting a bit into investments. But does it ever feel like you're just stuck on a treadmill? Like your wealth just isn't growing the way you thought it would? Well, in this explainer, we're going to dive into a really powerful strategy to help you finally break out of that cycle. I mean, let's be real for a second. You put your hard-earned money into different investments, hoping, to see it grow. But when you factor in the rising cost of, well, everything, are you really getting ahead? Or does it feel more like you're just running to stand still? Okay, so here's the harsh truth. That official inflation number you hear about, it doesn't really tell the whole story. For the Indian middle class, the real inflation for things that actually matter, like your kid's education, a nice family vacation, all those little lifestyle upgrades, it's much closer to 8 or 9%. Now put that next to traditional assets like property or FDs, which might be growing at, 7 or 8%? You see the problem here, right? Your money is actually losing value every single year. And that right there is the trap. When your money is growing at the same rate as your expenses are rising, you're not getting any richer. You're just breaking even. And let me tell you, in the race for financial freedom, breaking even means you are effectively falling behind. So how in the world do we get out of this trap? Well, the answer is to aim for something investors call alpha. Think of it as the secret sauce, right? It's the return you get above and beyond what the general market is doing. It's the difference between just keeping up and actually pulling way ahead to build real wealth. Now look, don't get me wrong, mutual funds are fantastic. They should absolutely be the solid foundation of your portfolio, and you can get great returns, maybe 12 to 20%. But if you want to add a turbocharged engine to that foundation to really generate that high alpha we're talking about, that's where direct stock investing comes into play. Let's just look at what's possible. This number, 23x, this is the kind of return that finance professor Vinny Arora made on a single stock, BSE, in just 4 to 5 years. And this wasn't his entire portfolio. This was one single position that created a life-changing amount of wealth. Now, this is not about gambling. It's not about getting lucky. Returns like this come from a very specific strategy. You find exceptional companies, and you have the conviction to invest a meaningful amount in them. It's about making a few smart, focused bets based on a clear framework, which, by the way, we're about to break down for you right now. So how do you actually find these potential game-changing companies? We're going to walk through a really simple but incredibly powerful 3-step framework that you can start using yourself to spot these potential winners.
And here it is. See? It's not rocket science. First, you spot the parts of the economy that are just booming. Second, within those sectors, you find the 1 or 2 companies that completely dominate the market. And third, you just make sure they're financially strong. So let's break down each one of these steps. Okay, step 1 is all about observation. You don't need some complex financial software to get started. Just look at the world around you. Are your friends and family traveling more than ever? That's a sign for the hospitality sector. Are people buying cars with sunroofs and more premium goods? That's the premiumization trend. Is every business you know talking about AI? That's a huge clue for the IT sector. The best ideas are usually hiding in plain sight. Okay, so once you've found a growing sector, step 2 is to find the big elephant in the room. You're looking for a monopoly or a duopoly. Basically, a company that has such a massive piece of the market, we're talking over 40%, that it's just incredibly difficult for anyone else to compete. These companies have a massive, massive advantage. I mean, think about it. Right here in India, in telecom, it's basically a 2-player game with Bharti and Reliance. Stock exchanges? BSE is the only one that's listed. Premium hotels? IHCL, with the Taj brand, they dominate. Cars? Maruti is still the king. Even food delivery has pretty much boiled down to Zomato and Swiggy. These are exactly the kinds of dominant players you're looking for. And now for the final and maybe the most crucial check. Step 3. You've found a great company in a booming industry, but is it actually healthy? Well, the single most important sign of a healthy company is its cash flow. Simply put, is more cash coming into the company than going out? As Vinny Arora says, the company has to be rich in cash, because that cash is the fuel that lets it grow, innovate, and survive any tough times. Okay, so finding a winner, that's one half of the battle. The other half is all about protecting your capital, because investing isn't just about making money. It's also about not losing the money you've worked so hard for. So let's talk a little bit about defense.
You know, your best defense against making a panicked decision is conviction. And that conviction comes from your research. When you follow a solid framework, you buy right. And that is what allows you to sit tight, to have the confidence to just tune out all the daily market noise and ignore those scary-looking price drops. But yeah, that's the critical question, isn't it? Conviction is important, but you can't be blind. How do you tell the difference between just meaningless daily ups and downs and a genuine red flag that's signaling a real problem with your investment? Well, there are really only two things that should truly shake your conviction. The first is any hint of promoter fraud. You know, the founders or the majority owners doing something unethical. That is an absolute non-negotiable deal breaker. The second is a huge change in the world that fundamentally breaks the company's business. So, for example, if oil prices stayed at $120 a barrel forever, well, that's a structural crisis for an airline, not just market noise. Let me be absolutely clear on this. There is zero tolerance for fraud. The word fraud is the single biggest red flag in all of investing. If you see it credibly associated with your company, you don't wait, you don't hope for a recovery, you get out. Period. Okay, let's put this all together. We've talked about the problem, we've gone through the framework for a solution, and we've covered the critical risks to watch for. So now let's just distill this down into the key takeaway that you can use to go from just breaking even to truly breaking out. So here is your framework. It's simple and it's powerful. Step 1, look for those growth trends in your daily life. Step 2, identify the undisputed leader in that space. And step 3, do a quick financial check to make sure they have strong, positive cash flow. That's it. That's the core of this monopoly strategy. You know, ultimately, applying this framework does more than just to help you pick stocks. It fundamentally changes your perspective. You stop being just a consumer and you start becoming an observer, constantly looking for the hidden business dynamics and the investment opportunities that are shaping your world. So I'll leave you with this question. The next time you order food or take a flight or buy a car, just take a second to think. Who is the dominant player here? Who really has the power? What monopoly is hiding right in front of you? Because the answer, well, it might just be your next great investment.
Here's the twist. You're not losing money because you made bad investments. You're losing because you're only keeping up. This isn't just about picking stocks anymore. It's about changing how you see the world. If you want to stop just keeping up and start getting ahead, subscribe, because real wealth isn't built by average returns. And next time you spend money, don't just think like a customer, think like an investor.